So check this out. Look at the cumulative premium that we've put into it, $841,000, okay? So that's a cumulative premium that you will ever put into this policy in your life. Now, you borrowed against it, you borrowed $875,000. So you actually were able to access more money than you put into it, and then still at the end of it, after all is said and done, you got $1.6 million left in net cash value, and you have a $1.8 million death benefit. Hey, what's going on, Cashflow Hackers? It's Chris with Life 180, and for this video, we're gonna be talking about whole life insurance, policy loans. How do you manage them? Do you have to pay them back? What does it all look like? How does it impact what you're trying to do with your policy? And hopefully, getting into this, I'll be able to give you some clarity on how this all works for you. Now, what I do wanna say is there are about 1 million different ways this could play out. So what I tried to do for this video is have 3 different illustrations put together to kind of break it down into its simplest parts, as I always try to do, and at least get the conversation going so you can have a good understanding about how these work, what your options are inside of the policy, what your options are outside of the policy with the decisions that you make. And then ultimately, if you have any questions as you go through this, make sure you leave them in the comment section below. I can make more videos to elaborate on this more, but it is a pretty complicated topic, if you really want to understand this inside and out. And so what I wanted to do is just utilize this video, start the conversation. I think it'll help a lot of people gain a lot more clarity on how policy loans work inside of policies, where the risks are, and ultimately, how can you utilize policy loans in retirement at the same time and for other assets ultimately. And to get right to it, what comes down to what I've been getting a lot of questions about is, if I take a policy loan, do I have to pay it back? And the answer is yes and no, and I'm gonna get into that on why and when and how. The right answer is maybe for you, so make sure you watch this video to the end so you will have clarity around that. So without further ado, let's get into this. I'm gonna get into my screen share, and I'm going to show you what I have going on here, and we will go from there. So take a look at this. So what I did was, like I said, I put 3 policies together, 3 illustrations, I should say, I put together, and you can see they're all the same. I've got 3 tabs right here. So you could see the first one, the second one, and the third one. And there is no difference with all these on the death benefit, on the cash value, the premium and the funding mechanism, and there's no difference in the increase in net cash value at the beginning of the policy. Now, the reason that I have 3 of them is because of the fact that they are all the same as far as funding, but they're all different as far as how the loans are being managed and the assumptions around which the loans are being managed. So ultimately, you have the flexibility when you borrow against the policy, how you're gonna handle and manage that loan payment. So what I wanna make sure is really, really clear in this illustration is that this isn't saying this is the way it would be for you. This is saying with these expectations and understanding that out of all the options that you have on how to manage your loans, these are kind of the different ways that it could play out for you. So let's get right into this. So what I wanted to show is $200,000 dump in. I basically, what I did here is I created what I call the ideal cash flow hacking policy, where you're putting in a massive front load into the policy. So it was a $180,000 front load with a $20,000 annual premium. You can see the $20,000 annual premium continues. It is, after that, a $17,000 a year because it goes down because of the PUA restrictions. And then it's fully paid up at 75. This is not a short pay policy because I wanted to be able to show having this, being able to utilize this policy for income in retirement, right? And for people that want to either have it as a volatility buffer or you want to be able to leverage this cash in some way, shape, or form in retirement. And it's important to understand that is possible. Now, here we go. Let's take a look at this and see what's going on here. So you can see $200,000 goes in year 1, $185,000 in net cash value that you could borrow against or get a cash value line of credit against, and almost $3 million a death benefit. So that's pretty sweet. Now the $20,000 annual premium. What I did here, I guess what I want to say before I get into anything else is one of the principles when it comes to borrowing against your policy is Nelson Nash always said, you never want to steal from your own bank, right? And so the biggest principle and the concept that you need to understand when you're first starting a policy like this, and when you're going to utilize the loans, whether it's from a cash value line of credit or leveraging the policy loan provision inside of the policy with the insurance company. You want to pay back if you're in the accumulation years. So one of the things that really bugs me is people that say that you're going to get rich by financing your cars. Now, that is not true. It's a function of, if you're going to buy a car and you're going to buy that car anyway, you want to make sure that you buy that car in the most efficient way possible. That's what a life insurance policy can do for you. It's going to help you make the most financially efficient decisions for you in your life. And I always kind of call it a filter. It's a filter in which you can run your financial decisions through to figure out, should I do this? Should I not? And you go from there. Now, that said, the rule of thumb is, while you're accumulating, as you can see here, I got a 41-year-old or a 40-year-old at the end of the first year is 41. And while they're in the accumulation years, let's call it for the first 20, 25 years here, you're always, if you borrowed against this, I didn't show any loans coming out against this policy because I'm moving under the assumption that you're always going to pay that back. If you're going to buy a car, let's face it, you shouldn't buy that car unless you could afford it out of cash flow. So borrow against the policy, pay that back as you would pay a car payment back to a bank. If you're going to buy a turnkey real estate investment, or if you're going to flip a house, fix and flip a house, if you're going to do if you're going to do hard money lending, one of the things that you need to understand is, if you borrow against a policy for any of that, you need to pay the policy back, pay the loan back to the insurance company, so that capacity, that collateral capacity, that liquid cash value becomes reliquified inside of your policy because you paid that life insurance loan back. Now, this is one of the things where, from an infinite banking perspective, that I kind of disagree with Nelson Nash, even though it's his deal, so it's hard to obviously disagree with the guy that created it. But one of the reasons that I like utilizing third-party banks with a cash value line of credit is because it reduces your cost of money. I don't think you can ever negate or ignore reducing the cost of money. Now, he's always saying, Nelson Nash is always saying, you got to take control of the banking function in your life. And I understand the idea of eliminating the use of banks and trying to, become your own banker. That's why he wrote the book. But when we talk about financial efficiency, we cannot ignore the cost of money. And at the end of the day, if we can leverage a bank and take advantage of them and lower that cost of our money, but still keep control because we have the cash over here and we have a set of rules and a system and a process that we run all of our decisions through, well, that's really being the banking system, right? That's taking over the banking function in your life because you're always in control. You can leverage a third-party line of credit to reduce your cost of money, which I don't think you can ignore. And I think a lot of pure infinite banking people kind of miss out on that concept. And so what I will say is, in this situation, we go through and we're going to pay the loans back. So I didn't show any loans coming out because what I really want to do in this video is answer the question, do you have to pay your loans back? Well, here's the deal. At 65, you can see as we're adding $20,000, $17,415 to the policy, this column right here, the increase in net cash value, this column you can see as we're paying $20,000 here in year 20 at age 60, the policy value is going up by $51,386. So it's growing by an extra $31,000 above and beyond what we put in for a premium. And you can see it gets better and better and better every year after that. Now it hits its peak where we're contributing $17,415 and it's growing by $62,000. So that's basically $45,000, let's ballpark it, in growth above and beyond what we're contributing to the policy. So what I did was I said, okay, let's take loans. So I'm going to scroll down here to the loan report, right? So I did, and I just wanted to show this for you. I'm not going to spend a lot of time down here, but I wanted to show you at 66, I showed borrowing $35,000 per year against a loan. Now, we're never going to pay this back, right? And so what you see here, this column right here with the $1,750, that's an interest expense. And then at the end of the year, this $35,000 plus $1,750 is $36,750. That is your total amount of a loan due. It's what you borrowed plus the interest. So when people say you pay simple interest, but the money compounds for you, well, the interest will compound for you against you if you don't pay it. Not a bad thing necessarily, or I mean, obviously, if you can manage this loan, then do, but you don't have to. And I'm showing you in the instance that you don't have to pay this loan back. Now, year two, 35,000. The interest keeps going up because it's on the 35 plus the 36,750. You're then going to have a higher interest payment. It's going to get bigger and bigger and bigger. I showed loans coming out until 90 years old. Now, full transparency in this policy, what we show here is you're taking 35,000 out, but you're also still making this $17,415. Now, you're making that premium payment up until age 75. Now, I know a lot of people are like, well, why am I gonna borrow against it and take $35,000 in income and still pay the premium payment? The answer is you probably don't want to, and I'm gonna address that. That's one of the reasons I have 3 different illustrations, just to show kind of the growth cycle of this so you understand what your options are. And I think it's important to understand, I'm showing $35,000 here, but you could also you could borrow against the policy just to pay your premium payments here if you needed to, right? Like that's a thing. That's not what I'm doing here. I'm actually gonna show a different way to pay the premium payments in a couple illustration examples here. But at the end of the day, this is the point. It's so flexible in what your options are, and this is why it's so important that you have an agent that understands all these moving parts that you can work with, and that's gonna be there with you to hold your hand, to coach you, to advise you, because people get in trouble if they start borrowing against these things and they don't understand their options. I've seen way too many people surrender these policies or make withdrawals or do the wrong things, and ends up costing them a lot of money because they managed their policy improperly, right? And so you can see here though, this is the policy loans. We take 35,000 up until 90 years old. Now what I wanna do here is I wanna go back to the illustration and I wanna show what's happening. So we're borrowing, you can see here, let me find 66. So you can see the net increase in cash value here was 62,000 at 65. Well, we're still contributing the 17,415, but we're also borrowing against it at 35,000. So you could see the net increase in cash value actually drop because we're borrowing against it. So the collateral capacity, as I call it, the net cash value, what's actually liquid inside of the policy, is growing by a lesser amount because you're borrowing against it. You're leveraging the policy, so it's not gonna grow at a quick rate, but you're able to borrow at the $35,000 against the policy and it's still gonna grow, which is a good thing. And so really simply, you can see here, this keeps going, it keeps going, it keeps going. The policy's growing. Now at 90 years old, you can see it had a couple years where it actually, because of the interest expense and the way that it was working, because of the way we were borrowing against it, we took the $35,000 a year. The interest expense is compounding against us, and but you could see here that even though, was it 65, 75, 85, for 25 years basically, we took $35,000 out of against the policy. So let me do the math on this. So 25 years times 35,000. So we took $875,000 we borrowed against this policy over that time frame. We borrowed against it $875,000. So check this out. Look at the cumulative premium that we've put into it, $841,000, okay? So that's a cumulative premium that you will ever put into this policy in your life. Now, you borrowed against it, you borrowed $875,000. So you actually were able to access more money than you put into it, and then still at the end of it, after all is said and done, you got $1.6 million left in net cash value, and you have a $1.8 million death benefit. So think about it from this perspective. You were able to borrow against this policy, access more money than you put into it, and it's still gonna leave behind $1,617,000. And this doesn't even account for the fact, this is why I'm so passionate about this. This doesn't account for the fact that if you do this and you utilize the Cashflow Hacking system, you're gonna borrow against this for your business, for your real estate investments, and you're gonna create a lot of wealth outside of the policy simply by being able to leverage this cash value the entire time, right? And so this on its own, as a very cookie cutter, plain Jane policy, is gonna get you where you wanna go. Now you can see here the $1,617,000 cash value at 91 and $1.873 million of death benefit. Here's the deal. What we're talking about is with this plain Jane policy, this is not how you would do it. I'm just kind of showing you worst case scenario. Do you have to pay the loans back? The answer is no. This is showing no loan repayment at all. Now, what you're gonna wanna do to keep it optimized is to pay back the loans in some way, shape, or form. Now, everybody knows paid up additions, right? I'm gonna go back to this one again. what we're doing here is we're not paying the loans back, but we're also utilizing the dividends to get more paid up additions, to purchase more paid up additions. And so that's important to understand. So now this one is this illustration is the same. You can see it's going to be exactly the same. I'm not going to have to spend as much time now because you understand the foundational components of it. This one, what's going to happen is you can see it's the same 62,258 right there. The cash value growth drops to 27,000. Because we're borrowing against it at 35,000, I'm going to go down to the loan portion, right? And what we're going to see here is we're actually less dividends to pay loans. So we're borrowing against it at 35,000, but this is what it looks like. This is the 35,000. We're still borrowing against the 35,000 constantly. That's what we're getting in cash flow out of the policy every single year against the policy if we want it every single year. But the difference here is we're utilizing the dividends instead of buying paid up additions. We're utilizing the dividends to pay the loans back. And actually, now that I say that, I want to go back down here again and I want to show you. And you can see here, because of that, the loan expenses are much less. The loan interest expense is much less. And so what we want to do is we want to go back up here now and look. Let's get to year 90 and compare the two. And you can see, because of this, 1.681, let's go back here, 1.617, or no, I'm sorry, at age 90, let's go 91 just to keep it the same. 1.617 is without managing the loans at all and without utilizing the dividends to pay the loans. But if we utilize the dividends to pay the loans, we have 1.719 million at that point in time with more death benefit as well. So it's interesting, because instead of using the dividends to buy more paid up additions, we're utilizing the dividends to control our interest expense, and it's actually allowing the policy to become more efficient. Now, what I have here still is people saying, well, Chris, it's great. I still started, it's the same deal. I was able to contribute the $841,000. I was able to borrow against it without having to pay it back at $875,000. So I'm able to, be able to do that. Mind you, once again, at 91 years old, we got 1.719 million left over. So if you needed to access much more than that or utilize this for any other way in addition, above and beyond this, what I'm showing here at the $35,000 a year, you can absolutely do that. What's fantastic about this though, or I guess what's not good about this one that I'm gonna show you is fantastic, is that at 65, in this instance, in this illustration, you're still having to come out of pocket for the $17,415 for the last 10 years of the premium. My guess is, once again, if you're taking income from it, you probably don't want to be funding it at the same time. So for the last example, what I did was I said, okay, let's utilize the dividends to manage the loan, the same as I did in the last policy, but also let's use what's called a premium offset to be able to fund the policy once we start borrowing against it. So what we do is the dividends will manage the loan expense, and above and beyond what it can manage for the loan expense, that we're going to utilize the dividends to pay the premium. And anything that the dividends will pay, so the dividends you can see here, right here, where does it say? I know it says it somewhere. Where did I have it? Hold on, let me go down to the loan category. Okay, so you can see here the net premium outlay, negative 27,000, it's growing. You're able to pull the 35,000 out. You don't have to worry about it. It's paying, this is actually, after the growth, after all said and done, it's growing by negative $27,585, or that's your net premium outlay, because you're actually pulling profit from it after everything is said and done. So when we go back here and we look at this, what we're gonna see is the same thing at age 90. I want to take a look at age 91 here the same way. Now the last two we looked at, I'm going to go back to 91 here. On the optimized one, we're just going to compare it, had 1,719,000. Now remember, this is going to have less because we didn't fund it. We're leveraging the policy. So it's got $1,467,000. Still not bad. You still contributed the $841,000. You still borrowed $875,000 against it. But the difference is, out of the portion of the money that you contributed, what is it, $17,415? So it's $174,150 basically was paid for through dividend payments and through the surrender, because you can see we had to surrender a portion of the policy, $10,000 per year, to cover this premium. Not a big deal, because you can surrender a portion of the premium because you've put so much money into this over the time. You can do that up to cost basis with no tax issues at all, and you're not going to have an issue. And so with that though, when we look at age 91, we're still able to pull that $875,000 against it. And we still have $1,467,000 left. And the reason this is a smaller number is because we were able to fund that last decade of the policy. So you actually put less of your money into it. And at the end of the day, this is the thing. You don't have to make the decision as to what you want to do during this time frame until you get there. A lot of people say, well, whole life isn't very good because it's not flexible. Whole life is extremely flexible if you fund it right, if you manage your cash flow right, and you understand what your options are with all the nuances inside of the policy. This is just kind of the 3 basic ways that you can manage it. And I think you need to understand this as you go into utilizing this as a foundational asset in your life. Once again, now what I want to do is I want to go back to the beginning and I want to say, okay, what does the life cycle of this policy look like now that we're getting into this? We always want to pay the loans back if we're borrowing against it while we're accumulating money. At year 2 in this instance, I'd have $207,000, right? With that $207,000, what I would want to do there is I would want to borrow against it. I'd put it into real estate. I'd use the positive cash flow from that real estate to pay back the insurance loan, the policy loan to the insurance company. As I do, that money is going to become recapitalized, reaccessible inside of my account. Then I can compound that. That's what my book Cashflow Hacking is all about. And the beautiful part is, while that money is sitting dormant, right? Because when you pay cash for a down payment on a house, you lose the ability for that cash to keep compounding for you. This is where we fix and solve that problem, right? And so now this account is going to grow infinitely better in a more efficient way. You're going to get much better long-term internal rates of return inside of a whole life policy than you are in any other fixed guaranteed asset on the face of the earth. And that's why I love it, because you don't have to give up the liquidity, the use, and the control of the money. And then when we get to retirement age here at 66, even though, by the way, if you do cash flow hacking, it'll be way sooner than this, but I'm kind of showing the traditional methodology of the mindset of retiring at 66. What you're showing here is you're borrowing against it, and then at that point in time, you don't have to pay the loans back. So this video is showing that you don't have to pay the loans back. That is the entire purpose of me showing you this video on paper, that you will not have to pay your loans back if you borrow against it and you manage this properly. You're going to be in great shape. You do want to make sure you're managing your loans the right way. You want to make sure that you're not taking such big loans that it's going to create problems in the policy, because you can create problems in the policy if you overstress it with too big of loans and you don't manage those loans properly. It could create stress internally, financially on the policy, and you could wind up with some negative consequences. But if you manage this properly, if you understand how it works, I truly believe there's no more powerful foundational asset on the face of the earth than a properly designed whole life insurance policy. Because if you see the leverage that this policy will provide you from a funding perspective, from a liquidity perspective, while you're accumulating and trying to invest in other real estate or in businesses, or even if you wanted to borrow it for crypto or other investments, that's totally up to you. It creates leverage. You're going to keep the money growing. You're going to have a self-completing plan with a death benefit that accompanies it. And then when we talk about getting towards the end, you get to borrow against it, and you still have guaranteed life insurance to pass on to the next generation on a tax-free basis, on a guaranteed basis. There's no other asset that will do it for you. That's why I call this a self-completing plan. What you want to happen will happen when you want it to happen, whether you're here to see it or not. So if you have any questions, let me know in the comment section below. If you haven't already, make sure you like and subscribe. That way, you get notified every single time I launch a new video. If you haven't, make sure you hit that bell. That way you're notified, because I'm putting out just a ton of content right now. If you're a life insurance agent, if you're somebody who's looking to learn about this stuff, I truly believe, or at least I try to put the best content out there on YouTube, on TikTok, on Instagram. So make sure, if you're not following me over on TikTok, it's real Chris Kirkpatrick. Instagram, same handle, real Chris Kirkpatrick. And that's it. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.